Hey guys, TommyBryson here, and today we're going to talk about asset allocation. And by the way, this is one of the most boring topics when it comes to finance, but we have to talk about it, okay? We have to talk about asset allocation, what it means, and also how to rebalance your portfolio yourself. This is what we're going to cover in this video right here. And by the way, guys, not every single financial topic is going to be like, oh my gosh, so important. Oh my gosh, it's so cool. The answer is, well, although this topic right here, asset allocation or rebalancing your portfolio, is not that exciting, okay? It is one of the most important topics ever, because if you pick incorrectly, you could be stuck with a portfolio that absolutely makes no sense whatsoever, and it will not be growing. And on top of that, you might be out of a ton of money if you're not rebalancing your portfolio, and you might be taking massive risks. So although this is boring, it is going to be one of the most important videos you're ever going to watch, okay? So listen up and put on your thinking caps, because basically this is going to be one of those videos, okay? And by the way, if you're new to my channel, guys, I upload videos on this channel every single day, so make sure to also start down and hit the bell so you're notified every single day I post a new video. And on top of that, also destroy the like button for the YouTube algorithm, and that way everyone else can watch this video about asset allocation and also how to rebalance your portfolio. Now, the first thing we have to talk about is basically, Tommy, what the heck is asset allocation and how does it actually work? The answer is, guys, asset allocation is just allocating your assets. That's it, okay? Okay, everybody got it? Okay, video over. I'll see you guys tomorrow. Bye. Okay, I'm kidding, okay, guys? I hated when I was in high school and a teacher would rephrase my question and ask me, hey, do you get it now? Asset allocation is allocating your assets. The answer is no. I didn't get it when I asked it, and I don't get it now that you rephrase the question. So I'm not going to do that, so don't worry about that, okay? And by the way, who are we kidding? In high school, there were no teachers that taught you anything about asset allocation, and that's why you're doing your research yourself right now, right here. Now, here's what asset allocation actually means. Asset allocation is basically how you distribute your investments, or for example, how you actually balance or organize your investments to basically optimize your risk level, or for example, optimize your entire growth, or for example, your performance, or for example, even how much money you're actually going to have coming in. Asset allocation is the most important part, because that's basically how you organize your investments to get you the most optimized performance. A simple way to understand it is basically, if you have a slice of pizza, okay, well, not a slice, a pizza pie, and you have, for example, 7 people, you basically want to, allocate it correctly so everyone gets a slice. However, this example is not accurate. And here's why. Because every time, number 2 here, every time an investor thinks about allocating their assets, what they basically do is they grab whatever money they have, they divide it equally and invest it into whatever they want to invest it into equally. And now they think they're actually allocating their assets correctly. However, asset allocation is not that simple. Asset allocation is basically distributing your assets, your money in a sense, across different markets, also in bonds and ETFs and stocks, and also index funds to basically get the most optimized performance. And that way your portfolio can actually grow correctly and have not that much risk. Now, at this point, you should understand why this is so boring, okay? Because all you're really doing is making sure your portfolio is organized the correct way so everything is actually done correctly. Now, I don't know about you guys, but the best way I learned anything was by learning it visually. So enough talking. I'm gonna show you guys right now my actual portfolio and how I myself actually go ahead and allocate my balance, okay? So if you're sleeping right now, wake up, because this is the most important part of the entire video, because obviously it's been proven by data and scientists, okay, and studies that seeing something visually and learning visually usually it sticks in your memory for a lot longer than just someone on YouTube talking and talking and talking and talking. So here's exactly how I allocate my portfolio. Now, the app I actually use for investments is called Acorns. I've been using it since 2018, and so far it's been great. And by the way, although you might see a fancy number here, like, oh my gosh, Tommy, you have $27,000 invested. The answer is, when I started, bro, I started with $7.80. Not that cool, not that exciting, not that, oh my gosh, right? But the point is, you keep investing, and over time, your money grows. That's all investment investment is, okay? So don't worry about, Tommy, I want this much money. The answer is no, bro. Worry about just getting started, and that's all that matters. Just get started with like $5 or whatever you have. The point is, investing is key, not how much you invest. Just invest, okay? Now, here is my actual asset allocation. Now, my portfolio is right here, okay? It's my portfolio, but here is how my assets are actually allocated or distributed, and that way everything is optimized. Now, what I do, guys, is very simple. All I do is I do 80% stock ETFs and then 20% into bonds. Now, Tommy, okay, video over. I got it. I understand. The answer is no, because like I told you guys before, asset allocation is a lot more difficult and a lot more complicated. And here's why. Because basically, you have to allocate it across different markets, and that way, if one market goes down, your other market goes up, and that way your investments are always balancing up, and that way you don't take that much risk. So right here, as you can see, guys, right now, I invest 10% of my money, my assets, go into government bonds. Now, these are called treasury bonds, and they're only going to mature in like 1 to 3 years. So overall, they're very short term. Now, Tommy, why do bonds if you're only 23 years old? The answer is because I like having predictable income, and I also like getting paid every single month from my investments, and that's why I also have them. Now, my theory is this, okay? In my 20s, I'm going to do 20% into bonds. When I'm actually 30, I'll do 30%. When I'm 40, I'll do 40%. When I'm 50, and so on and so on. But once I hit 60 or 70, I just might go 80-20, 80% like bonds and then 20% into stocks, because basically by that point, I won the investment game, and I don't want to take that much risk with the young boys, okay? I'm no longer young, I'm old. I beat the game. I don't need to take any more risks, okay? However, that is not all, because although I have government bonds, I also have corporate bonds, and I also invest 10%. But because corporate bonds are a lot more risky than the government actually shutting down and me not getting back my money, the answer is I actually get paid more money. Now, as you guys can see right here, I have holdings in CVS, in GE, and also a few other big companies. Now, these right here, these bonds in corporate companies are AA. So basically, these investments are pretty safe. Now, the likelihood of these companies actually going bankrupt is actually very low. But again, this is also an ETF. So basically, I'm invested across different like categories of like companies. So that way, if one goes down, I don't care, because basically it's an ETF and all my investments are basically organized, okay? I have a lot of them. So I don't have just one company. No, I have an ETF that's made out of different companies, and that way I can also limit my risk. But that's not all also, guys, okay? Because I also have 38% of my money going into large company stocks. Now, Tommy, why do you have so much of your money going and being allocated into the US market? Now, if you guys don't know, large companies right here is basically being invested into the S&P 500. Now, those are the top 500 companies in the US, and you might have heard about it before. Basically, the S&P 500 index fund, well, this is what that ETF is actually trying to replicate and it's trying to get me, okay? So basically, right now, I have holdings, for example, in Microsoft, in Apple, in Amazon, Facebook, and also in Google. That's what this ETF right here is mostly made out of. Although I have another like 495 companies inside this ETF right here, but these right here are the top holdings in this ETF right here. And why? Because basically I have a lot of trust in the US market in the future, and that's why I invest the bulk of my money, 38%, in the US market. However, this is big companies, also slow performance, and also kind of like 7 to 8% returns every single year. And that's why I also have small company stocks. Now, these might go up one year, for example, 13%, the next year maybe 20%, but sometimes it might not actually perform as good, stable, big companies, because again, it's more risky. So that's why here I only invest around 14%. On top of that, I also have emerging market stocks, basically investing outside of America in emerging markets, for example, in China, in Brazil, also South Africa. But the point is, again, this is very risky, and that's why it's only about 4% of my portfolio. But again, when this goes up or it might go down, other parts of my portfolio basically also go up and down, and that way everything fluctuates and everything stays balanced. That's why allocating is so boring, but it's also so important. Now, on top of that, guys, I also have real estate stocks, okay? Basically, I want to make sure I'm also distributed or allocated across real estate, because basically that's more stable investments that basically create for me dividends that are actually pretty high, because again, real estate, it pays rent, is very consistent, very predictable, and you'll get money unless we have like unless we have like a 2008 crisis. But the likelihood of that happening is actually, it's actually not gonna happen in a long time because of everything that's actually going on with the government right now and all the safety pins they actually put in place. Okay, and now lastly, the last part of my portfolio is international companies, and this is only around 16%. Now this includes, for example, Samsung, Toyota, also Nestle. Now the answer is that all these companies, most likely you already know them, but the answer is I do 16% here because the idea is, although I love the US, I never know if one year we're going to have a bad year in the US, but the international market might actually be booming. So again, asset allocation at a high level looks like this, and the idea is you want to have your assets allocated, and that way you have balance and everything is fine. However, if you're not using an app like Acorns, there's also something else you have to worry about, and this is even more boring than asset allocation, okay? And this is called rebalancing your portfolio. So as you guys know, I do 80% into stock ETFs and then 20% into bonds, okay? 10% corporate, 10% government bonds, okay? However, if you're investing and buying shares yourself here and there in these investments, well, one, they're very expensive and you can't really just buy a piece of it like I do with Acorns. But the idea is that basically not every single time you're gonna have a perfect ratio. You might be, for example, in corporate bonds like 20% or 15%, and you might have to rebalance and go back to 10%. So that means basically selling some of your bonds to then buy some stocks and then rebalance everything. And you have to do this every 12 to 18 months. Now, if you ask me, that is very boring and I don't want to deal with it, okay? So basically, by having Acorns rebalance my portfolio automatically for me, and I don't have to worry about it. Now, Acorns only costs around $1 per month, and when you sign up with my link, you get $5, and basically you also get paid dividends from your bonds and also your stocks. So basically, eventually, in like the first year or so, if you're investing correctly, maybe $10 every single week, in the first year, your investments are going to pay off that $1 fee every single month, which is pretty low if you ask me. But guys, overall, if you made it all the way to the end of the video, I have a confession to tell you. And that is basically that asset allocation and rebalancing your portfolio is actually, for me, not a boring topic. I actually love this stuff, okay? But the answer is most people think it's boring, but I actually enjoy it. And if you made it all the way to the end of this video, then you probably think it's actually pretty exciting also, okay? So comment down below and let me know, did you learn anything in this video? Because with all my videos, that is always my goal. And asset allocation is by far, although it's boring, is one of the most important things. Because basically, if you allocate your assets incorrectly, for example, you're 65 years old and you're still doing, for example, 20% bonds and then 80% stocks, well, if we have a bad year, you might be out of a lot of money. And that's why the older you get, the less risk you want to take and the more conservative you actually want to get. So now that I'm young, 23 years old, well, I can take more risks and go 80-20. But as I get older, I'm going to switch it up and allocate my assets differently. Again, distribute and make sure everything is evenly in different areas, and that way my balanced portfolio is actually balanced and I'm expected to get some really good returns. But guys, overall, that's the end of the video, and don't forget, comment down below and let me know if you learned anything, and if you have any questions, also comment down below and let me know. I'll respond to your comments also. And as always, if you enjoyed the video right here, guys, well, destroy the like button for the YouTube algorithm, and on top of that, if you're new here, subscribe to the channel and hit the bell so you're notified every time I post a new video. And guess what? That is also free, so go ahead, okay? On top of that, follow me on Instagram, TommyBryson. If you have any questions, I also answer my DMs over there, and I'll see you guys tomorrow. But before I go, if you want to watch the video on the basics of investing, well, watch this video right here and click my face right around. I'll see you guys tomorrow. Thanks for watching, and as always, peace.